Gold. Globally the oldest and longest standing financial asset by far, compared to home prices, has never in the history of this chart going back 135 years to 1889, except for when gold was briefly in a bubble in 1980. The difference between today and 1980 is that in 1980 it took people 4.3 years of work to be able to afford a home, while today it costs Americans 7 years of labor, surpassing the peak of the housing bubble before the Great Financial Crisis, the highest in over 75 years of data. Other financial assets like the S&P 500, the United States stock market, has also never been more expensive, with a dividend yield lowest on record outside of the dot-com bubble, and compared to what companies have been able to make on average over the last 10 years, also almost never more expensive. So when compared to financial assets and things that you need like housing, United States incomes have never been lower. And if you think that's bad, hold on to your hat, because it might get even worse. Today is Thursday, April 9th, 2026. That's why our first headline today is U.S. incomes are the largest laggard. And I want to dive into some financial data released today, starting with personal savings, spending, and income, all three being lower than expected. Month over month, personal spending was supposed to grow by 0.6% and instead only 0.5%. Personal income was supposed to grow by 0.3% and instead declined by 0.1%. And the personal savings rate dropped in January from 4.5%, already a low number, down to 4%. Below 5% is bad, and it's falling. So not only have financial assets never been more expensive compared to things people use and need, people are unable to save very much money, they're unable to spend as much money as they might like to, and their incomes are shrinking. Oh wait, but there's more. Final GDP was revised down from 0.7% for quarter four of 2025 down to a final revision of only 0.5%. We also got our weekly jobless claims, which were not very high, nothing to get excited about. And the PCE came out today, with the headline being at 2.8% year over year, at core being at 3%, which is notably still higher than the Fed target of 2%. GDP barely positive, inflation high, incomes lower than ever before. What could possibly go wrong? Let's hear from Tom Lee. Permabill says the bottom is in. As you can see from this headline from CNBC, fund stress Tom Lee says the market has bottomed. Stocks are headed to all-time highs. And he might be right, because you never know how high Mr. Market can go. The way that I look at it, the higher we go at this point, the larger the fall. But to know the future, you truly need a crystal ball. Community topics. What moves, if any, did you make today? Robschild sits on hands. Coming up still tomorrow, we have the CPI. Also, the end of the war. When will the Strait of Hormuz open? Why go into detail at this point? It's not open. You've seen the headlines. I'm hearing some people say it's impossible for the U.S. to not finish this deal, to prevent certain characters from enriching certain things to a certain degree, and I'm hearing others suggest that it's just time to leave this thing alone, and that might be what ends up happening. After all, at the end of the day, it ended up being a taco, the way that I look at it. If Tom Lee is right and we do go to all-time highs, you can bet your hat that we will get a lot more tariffs coming. Anyway, we'll get on to the charts. Thank you for watching, liking, subscribing, sharing, commenting, and all of your support. Betting markets appear to still be betting on April 7th as the date that Iran and Israel and U.S. conflict already ended, with $11 million still sitting here with a 52% chance now, with increasing chances as we get further out at this point. There seems to be a growing belief that this thing is already over. We also have military action against Iran ends on April 9th with a 94% probability. Not a lot of volume on this one though. So let's pump the stock market. The S&P 500 rose 0.6% today. The VIX has cooled off now, notably below 20. We've been above 20 for quite some time. And the volatility of volatility, the VVIX is medium high today at 105.37, certainly a lot lower than where we have been. This is the 8th day in a row where I've noticed an inverse correlation between bonds and stocks. When stocks are going up, TLT going down, and when stocks have been going down, TLT has been going up for the most part. Yesterday, like I said, it wasn't exactly that. They both went up, but TLT went up only a little bit with a red candle. S&P 500 went up a lot with a green candle. It's acting like it's an inverse relationship. And I know maybe this is just noise because it's only for 7 days so far, but it also might represent a trend change. The MOVE index has been falling at a faster rate than it rose, still above its previous bottom in January, but falling very quickly. The 2-year Treasury note yield fell 1 basis point today, essentially going flat, and the 10-year went basically flat as well, dropping 2 basis points. Bitcoin still looking bullish after having growing momentum to the upside, consolidating towards the top. This is just still simply bullish looking. And crude oil looks simply bearish looking at this point, with Tuesday's red candle and consolidation at the bottom. The chart suggests it may be headed lower. Copper, after rising above its previous broken and confirmed neckline, went basically flat today. We're at 579. Silver, the devil's metal, also basically flat today at 75.23, and gold going fairly flat, only up 1% to 47.65. I mentioned yesterday looking at HYG divided by SHI. It was obvious credit spreads were getting tighter. I said below 3% is exactly what happened. We got an update this morning. Junk bond credit spreads have fallen to 2.94%. The reason I laugh is because when you scroll out on this chart, it's not common that we get below 3%. When we get below 3%, it's typically spells out a bit of complacency. And I bring this up a million times, but just to bring it up once more, before the great financial crisis, this is what complacency can do in junk bond credit spreads being really tight. In May of 2007, it was only 2.46% over the Treasury rate of what people were asking for when buying junk bonds. And they're called junk bonds for a reason, because they default sometimes. And, this is what happens. And what happened in the great financial crisis, we blew out completely to almost junk bond credit spread of 20%. So for now, the junk bond credit market is saying there's very little risk that junk bond debtors will be unable or late on their interest payments. So I don't know, maybe we should all just go to the bank and borrow $1 million to buy FARTCOIN. What a time to be involved with markets. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time at Robschild.